Income statement is constructed following two major accounting principles. They are matching principle and accrual principle. So let me explain what these two principles are. The matching principle directs a company to report an expense on its income statement in the same period as the related revenues. Remember, same period as the related revenues. The accrual principle is the concept that you should record accounting transactions in the period in which they actually occur, rather than the period in which the cash flows related to them occur. Let me give you some examples to make these two principles clear to you. Let's first start with matching principle. Big Appliance has sold kitchen appliances for 30 years in a small town. It purchases a large appliance from wholesalers for $5,000 and resells it to a local restaurant for $8,000. So, at the end of the period, Big Appliance should match the $5,000 cost with the $8,000 revenue. In essence, what you sell over a period of time for which you're making the income statement is recorded as revenue. In this case, $8,000. And only those payments that you incur to earn that revenue, i.e. $8,000, are recorded in the income statement as expenses, i.e. $5,000, to calculate profits or losses. Let's look at another example. If a company purchases an elaborate office system for $252,000 that will be useful for 7 years, the company will match $252,000 divided by 7 years, i.e. $36,000 of expense each year to its yearly income statement. So now let's look at the second principle, that is accrual principle, now that we've understood matching principle. Accrual principle tracks promise and not settlement. What does that mean? When a company makes sales and majority of its sales are against credit, record it irrespective of whether you made the sales against cash or credit. For example, if a customer receives delivery of goods but promises to make the payment, say within 30 days, in accordance with accrual principle, revenue is recognized when the delivery is made, not when the payment is received. So record sales when you invoice the customer rather than when the customer pays you. Similarly, record an expense when you incur it rather than when you pay for it. Also, record a commission in the period when the salesperson earns it rather than the period in which he is paid it. Record wages in the period earned rather than in the period paid. So, when you promise to pay for a good or service that you received, record it as an expense when you received the good or service, even if you pay for it at a later point in time. Similarly, when someone promises to pay you for a good or service you delivered, record it as a revenue when you sell the good or service, even if you receive the payment later. and not right away. That's why we say the income statement tracks promise and not settlement.